Okay, I think we're good here. I believe we are live. As you guys tune in, just let me know if you can hear the audio quality and the video quality as we wait for Scott to join in here. So tonight we're going to be talking real estate, all things real estate, a couple different topics tonight. As you will see, is now a good time to buy, the current state of the market, things like that. We're gonna ask Scott. Scott is a realtor in Windsor, and he has been doing it for quite some time. So I see you guys are tuning in here. Let me know if you can hear me and the video quality is good, sound quality is good. Just give me a thumbs up. I've only gone live on other people's channels. I haven't done it on my own, so this is new to me. Here we go. Got some waves. Just let me know if you guys can hear me. Yeah, we've got the emoji there. All right. So as we wait, there's Scott. I'm going to see how to bring him in here. And we're going to...
Scott Innocente from Windsor, the realtor for always working for you. That is the realtor name. There he is.
Hey, what's up, man?
What's happening, buddy?
Not much. My first IG live.
Oh shit, breaking the seal. I've only done it as a guest on others, but it's actually pretty simple. So here we are, man. How's the day going?
Yeah, it's all good. It's all good. Just got in pretty crazy market still, as I'm sure we all know. How about yourself?
Yeah, busy day as well. On the banking side, the real estate, mortgages, everything today. A bit of a mixed bag, but I was looking forward to coming on here to do this.
Yeah.
Talk about a few things in the real estate market. For those who don't know, I met Scott actually. I'm frequently visiting like real estate forums and groups and chiming in and being a part of that. And I saw that Scott was always a part of a Windsor group on Bigger Pockets, always dropping free value there. And I was looking to start investing in Windsor, and I kept seeing this same face over and over. So I reached out to him. We hopped on a call. He wanted to know like what my investing goals are, why Windsor, what type of things do you look for as an investor. He understood completely because he is an investor himself. And for those looking for a realtor, you should work with somebody who is an investor themselves. They understand what you're looking for. They're going to be an asset to your team. And we just kind of kicked it off from there. And within a couple of months, we were buying properties, right?
Sure, yes, sir. I actually think it's dangerous not to work with an agent that is an investor themselves. I see some really weird stuff out there. You know, there's a certain mindset with investment property. It boils down to numbers and locations and a few other things. And if you don't understand that, if you're not an investor yourself, I just don't think you'll have that knowledge to guide somebody properly. So just be careful out there for any prospective buyers or investors. And yeah, that's some advice there. But I think you had some topics for us tonight. Anything specific?
Yeah, the first thing that I want to kick it off with is something that's on everybody's minds. We both have conversations about this all the time. Questions: are we at a market peak? Is it still a good time to buy? What's going to happen in the short term? Am I too late? So why don't we touch on like what are the big factors that are influencing the market right now? Why are we in this hot market as we are, and where are we going from here type of thing? Is it still a good time to buy?
Yeah, I mean, I always think it's a good time to buy real estate, and I know that's a pretty broad statement, but if I could qualify it, it's always a good time to buy capital. Like, I don't know what else to say. I don't care if the market's up, down, or sideways. I don't know what better option you have for your money over a long period of time. Are we at the top of the market now? I don't know. In short, if I was a betting man in Windsor specifically, I would bet that the answer is no, because we're the most affordable city still in the country. And then even across Canada, I mean, just look at the fundamentals, right? Look at the supply-demand imbalance. There's clearly not enough housing in the country. The federal government is clearly out of touch with what's happening. They have no idea how to do this. They do not understand business. You can't let in 400,000 people a year in the middle of a housing crisis and expect it to correct. So in my opinion, like, I don't know what's going to happen next year or the year after, but over 20 to 25 years, the future of Canadian real estate ownership is, I don't know if there's a better country really to invest in my opinion. So I guess my advice would be don't try to predict next year or the year after. Look at 20 to 25. I think our projected population in the 10 to 20 years, according to the federal government, is like 45 to 60 million people. Where are these people going to live?
It's crazy, right? Yeah, the immigration thing alone is huge, and yeah, I think you're bang on there. That's what they're projecting is 400,000 a year into the country, and I've seen that Ontario gets over 40% of the immigrants that come here. And Ontario has a lot of strict rules for building and expanding development, and that puts pressure on supply for homes, right? And that's just immigration. I think possibly the biggest factor is cheap borrowing costs, like ultra cheap borrowing mortgage rates. This is a huge factor for why people are jumping into real estate with both feet and getting larger mortgages, refinancing their homes, and taking on more debt. In some cases that are good debt, other cases they're kind of being a little bit over leveraged. But you touched on cash flow there, and why don't we dig deeper into the reasons behind why cash flow is so important, especially in a time like this where we could be peaking. And if we do go through a correction, I have a theory that the two main things that are going to I guess, be separating the successful investors from those who do not make it, one are cash flow, right? You need income to go through a correction and ride it out. And the second one is liquidity. If you want to even expand your portfolio even further, you need to be buying in a correction, not just holding through it, not selling. You want liquidity. So that kind of brings me into the other assets and things like that. But what are your thoughts on how to get through a correction if we go that way?
Yeah, I think you hit the nail on the head. You should be a buyer in a correction, right? Because over the next 25 years, the fundamentals of Canadian real estate haven't changed. Even when COVID hit, I was telling people, look, I don't know what's going to happen in the next year or two. It was scary, right? People were out of their jobs and all this crazy stuff was happening. Nobody really knew what was going to happen. But my point is that this doesn't change the long-term fundamentals of Canadian real estate. So in the middle of a correction, a lot of people think that they're mentally prepared for it until it happens. And then when it happens, the people that think that they're going to make moves actually don't do anything. And I know that used to be myself in the stock market and whatnot until I had to, develop some emotional toughness. And I think what gets you through a correction is the long-term mindset and understanding long-term fundamentals, because corrections don't tell you the fundamentals. It's typically emotion-driven. In a depression, people actually get depressed. They actually get scared. They actually don't make moves. So it's not all about the economy, right? Because I think there's, in the last correction, there's a 10% unemployment rate in Canada or plus or minus. That means that there's a 90% employment rate, It's not like the economy stops. It just contracts for a period of time. So people get scared. That's when you should be most opportunistic. And I think you're right. If you don't have cash flowing properties, it's going to be hard for the banks to lend you money because it's not going to be covering the debt service, of course, right? So I think that's kind of what you're hinting at there.
Yeah, it's tough on the lending side for sure, but also for like investor psychology. For example, like real estate is not fully passive. It takes some management, it takes some work. There's headaches, there's risk and liability, all types of things like that. So if we're going through a correction or even like a flat market, it's totally possible. We go through a flat market for 5 to 10 years. We've done it before. So picture yourself owning multiple properties for 5 to 10 years. You're all in on real estate and they don't cash flow. You're breaking even or you're slightly negative. So you're only making money because you're paying down the debt a little bit, but you're not being paid well for the problems that you're solving if that's the only form of income that you have. I've always said that the appreciation is a bonus. I invest for cash flow and mortgage pay down, and I have my benchmarks for that. I look for 20% ROI for those two combined. And if the prices do not move, I'm making 20% on my money. That's still worth the effort versus something more passive like the stock market. And if we get appreciation, and I agree with you, longer term, we're going to see it. But the appreciation is a bonus, in my opinion, in most cases.
Yes, I agree. And what I would recommend that investors don't do, I think people, I agree with qualifying a property, I agree with counting appreciation as zero, because over 25 years with inflation and population growth, prices will be higher. It's an unstoppable force. They can't not be, unless something drastic in the world changes and people don't live in homes anymore, which I think is happening.
Right.
So I will run my numbers with a 3% appreciation rate over 25 years. I don't know what the next 2, 3, 4, 5 years brings, but over 25 years, if it's not at least 3% in Canada, I'll jump off a bridge or something, right? So I'm not running numbers for 2 or 3 years. I'm running numbers for 25 because I plan on owning everything for 25 years. So that's one way to do it. If you want to be more liquid and trade in and out and try to time things, then maybe you might want to be a little bit more stringent with your numbers, or make sure you're prepared to buy in the crash. How I would prepare to buy in the crash is I'm going to make sure my income's high enough that the banks will lend me money, and my properties are all cash flow positive, so they should cover themselves at least, and I should be able to still access capital from banks and whoever else and buy more property, hopefully at a discount.
Yeah, that's another huge point, is the lending side. And when you have properties that are cash flowing heavily, it makes it easier to expand your portfolio and grow because of the income that's attached to them. If you have slightly negative cash flowing properties, like a lot of people have in single family homes or pre-construction condos with heavy condo fees, you're capped on how many of those you can buy, because each one slightly affects your application, your mortgage application negatively, whereas a strong multifamily might do the opposite.
A 1.1 ratio, like what is it for a rental property?
Different banks use different formulas, but Scotiabank is a huge bank for investors, and the way that they do it would just be 50% of the gross income used to cover the debt service. So if you're cash, yeah. So I mean, it's a tough benchmark to meet on certain properties, but multifamily can make that benchmark.
Yeah, and I talked to a guy from CIBC today who mentioned that very thing. And what he made a comment, like in Windsor specifically, because another thing I want to encourage people to really understand is that real estate's hyper local. So if somebody's out there saying, "Oh, Canada's real estate market is too hot," like that's fine across Canada, but like, what about my specific market? What about small town Windsor, the most affordable city in the province, one of the most affordable in the country? Like, am I worried about a top? No, because we're now an extension of the GTA. If I was buying in BC or Toronto, would I be worried about the top? Yeah, of course. It's always the top, right? So I encourage people to understand that it is hyper-local. And the mortgage guy I spoke with today, he said that because rents are so high, like in Windsor specifically, it's very easy to hit those metrics where you have the 1.1% 1.1 times debt coverage there that specific bank looks for. So when you buy these properties, it's actually not, in Windsor specifically, it's not really a net negative against your borrowing power, because the rents are high enough to cover what you pay for. So you can really scale pretty easily if you have the capital.
Yeah, and that's mainly why I invest outside of the city. Like, I live in Toronto, but I don't really invest in Toronto. I have a couple of condos here. Those are more appreciation plays. But the bulk of my portfolio is outside of the city. St. Catharines, Durham, Windsor, even north of Toronto. I'm looking at Sudbury. Like, I'm in a bunch of different markets. I'm actually looking at Calgary as well. But, you touched on the difference in numbers and everything being local. And, the rents in Windsor, for example, are not that much lower than some of the cities just outside of Toronto, but the purchase price is so much lower, which makes the rent to purchase price ratio so much higher. I guess that's what you're saying, right?
Yeah, exactly. Like, it's pretty easy to buy in Windsor right now. Obviously, that's going to dry up over time. It's going to become more difficult. You're going to have to get more creative.
Yeah.
But yeah, I don't paint a broad brush of Canada's real estate market. Like, I always read these articles from RBC about Canada's housing market and this and that. I think Vancouver and Toronto contribute $150,000 to the average Canadian price. So I don't care what's going on out there. I care about my hyper-local market. I haven't really investigated many other markets, to be honest, because I just think Windsor's the best right now, other than the U.S., of course, which I'm pretty stoked about right now. I think they're in phase one of what Canada's been in for the past decade or so, most of the major cities here, which is just a shortage of housing and too much money, too many buyers, too many investors for the housing supply. I think that's just starting in a lot of U.S. states, but yeah, I mean, if this market gets tapped out, it's a new world, right? We can invest anywhere now.
Yeah. And that brings me to, I believe that you can make money in real estate in a variety of different ways. There's a lot of different strategies and ways to make money. You don't have to just choose one that works for somebody else. And that brings me to, like, what strategies are your favorite? What are you using in your current market there? What type of strategies and why those ones?
So myself personally, I'm busy. I have a full-time job. I'm not handy. I don't want to be handy. I don't want to do any renovations. I like turnkey. I like new. I like premium. I like premium locations. But they all cash flow. And what I find is that I might buy a $600,000 duplex instead of a $400,000 duplex, but the percentage returns are very close because you pay a higher price, you get higher rent, you have lower expenses, you have a better property. So I'll always pay more for the better product because I think long term you're going to make more money.
Yeah.
Now I'm in a, I already have a portfolio I can draw from. So I have maybe more access to capital than some beginners that, I know where I started, it wasn't like this, but if you're a beginner, you might have to think outside the box a little bit. You might want to execute the BRRRR strategy, or one of the things that I think is coming up next is auxiliary dwelling units and adding another unit onto the back of a lot or into an alleyway, which is new in these smaller cities like Windsor. It's just starting to happen now, but I understand that they're all over like the West Coast, all over more expensive markets like probably the GTA. I don't really know, but do you guys see those in your area there?
Yeah, definitely. And I mean, there's a variety of different strategies that you can use. And on the topic of being a beginner, you may want to avoid those turnkey rentals like you were talking about as more of a seasoned investor with more access to capital, because when you buy a turnkey, it's going to take a while to build equity. And the idea is to build that equity so you can borrow it back, is to refinance the property as soon as possible.
Here's the thing, bro. I want to touch on this. In a normal market, that's true. Now, my personal view of Windsor's market right now is we're in a hyper growth phase. We're in a boom. So that was true, but the premium stuff that I bought last year appreciated 35%. So that and at one point, like you don't want to bank on that. But I did have a pretty clear view of what was happening here, right? I'm in the game every day. I'm talking to people every day. It's really a crisis. I anticipated 20-25% because I saw what was happening. So I actually I'm able to access my capital really quickly in this particular market. Now, obviously, you can't always bank on that.
Yeah.
And whether you're a beginner, some beginners do have a lot of capital. They could buy 2 or 3 A-class properties over a year period, right? So not all beginners are in the same financial position. If you're a beginner with limited capital, obviously a different story. You might have to house hack or something like that. But I would recommend that you get into the market as soon as you can in whatever form that you can into cash flowing property. I want to hit another point too. A lot of people, I used to think this myself, I would never buy a pre-construction condo. I would never buy something that's brand new because I thought that the returns I could find higher returns somewhere else. I'm not buying for appreciation. Yeah. And I think that's the wrong mentality. I think if you understand your market and what's happening, you can buy for appreciation. Ideally, it's something that's still cash flow positive, but a small percentage of my portfolio would bank on appreciation even if it wasn't cash flow positive because we're in a housing crisis.
Yeah. That pre-construction topic, let's deal with that for a second because, I was in the same boat. I was always looking for cash flow and income and stuff like that. But you've got some projects right now that you're selling. I don't know if there's still availability, but I've reserved 3 of them. And, I have one in Toronto as well. And what I look for in those pre-construction projects are the dealer or the builder incentives. What's often common nowadays is having management built in from the builder for a couple of years, 2 or 3 years of built-in management. So you're completely hands off at a guaranteed rental rate. Downtown, I'm getting for a 1-bedroom condo guaranteed $29.50 a month for 2 years, which is going to be cash flow positive, and the interest rates have only gone down since reserving this condo. So that one's going to be even better. Now, the ones that I like about Windsor that I've reserved with you was the very low deposit structure, which puts maximum leverage on your capital.
It was insane.
Like ultra low, it's not that hard to double your money.
Yeah, people need to understand if you can reserve a condo, let's just call it a $400,000 condo for 40 grand, let's say, that's 10% down payment. I predict that by the time these are built in 1.5 to 2 years, these will be worth at least $50,000 more than they are now. Why? Because we're in a housing crisis. That's why. There's not enough houses. I see what's happening every day. So if you make $50,000 on a $40,000 investment, that's 1.25 times your money. Go try to do that in the stock market. Go try to do that in any other investment class. And when the project is done, you can close on it, be cash flow positive, have somebody else paying your mortgage, And, you know, over the next couple, here's what I think about Windsor. That condo that we're looking at there in any other city is $100 to $150,000 more than here in Windsor. So we're the cheapest, like, you know, cheapest new construction you could find anywhere. So to me, you know, we're just playing catch up with the rest of the market in Windsor specifically. But worst case scenario, you have a cash flow positive asset that's probably going to double your equity in within 2 years. And if it keeps going at the current pace, it might be triple or more.
The thing is, like, when you close on those pre-construction condos, you got to put 20% down by the end of it. But there's that 1.5 to 2 year phase. And the question is, how much of your capital is in it from those during those 2 years? So if you're only in for 5% or 10%, your ROI is calculated on the money you've invested, not what you're going to invest, because your money could be working elsewhere in the meantime.
That's a great point. And I want people to understand too that if we're right, we're making educated bets here. But like the one I bought in Ottawa, I bought it for $250. By the time it was built, it was worth $400. I pulled out more money than I put into it, right? I had to close, right? You put the 20% down, but then I refied it at $400K. I think I pulled out $10,000 more than I put in. I have a free condo. I have a free condo unit, right? And I would, if I was a betting man, I bet you that these projects here are going to be close to that by the time they're built, because it's 2 years away. Land costs and building costs are insane. It's impossible to develop anything. I'm trying to get a driveway permit right now for my duplex. It's a nightmare. They're brutal. Like the red tape and the lack of communication from these bureaucratic Canadian government officials is insane. Imagine trying to build a 50-unit tower, right? Like it's years. So we're always going to be in a shortage. I guess the question would be, is the government going to do something heavy-handed and come in with some heavy aggressive rates to shut things down? My personal opinion, I'd love to get your thoughts on it. My personal opinion is, like, I don't know, do they want to do that? Like, do they want to crash the economy? Do they want to, you know, make people broke? Do they want to have people not able to pay their mortgages? Like, what is that what we're betting on here? Like,
yeah, my gut feeling, and I feel pretty strongly about it, it's going to be slow and gradual, the interest rate increases, because the government and the banks are fully aware that Canadians specifically keep a large portion of their wealth in their homes. And although Canadians are like more faithful to their mortgage payments than other countries, we have a very good track record of keeping our mortgage payments and avoiding defaults. It's still a fact that we have a lot of our wealth tied up in real estate, and that jacking up the rates too quickly would crash the real estate market. And I don't think they're going to do that.
Yeah, because here's the way I look at it. The Canadian banks are one with the government. They're the same entity. They work hand in hand. Those bank CEOs are at the table with the, you know, they're greasing them probably, you know, whatever goes on behind the scenes, I don't know. But if I can't make my mortgage payment, guess who owns the house? RBC, right? They don't want to own a large portfolio of real estate. The Canadian government doesn't want them to. So I think people have this thought that the Canadian government's going to come out and just blast rates to 7% and crash everything. And I'm like, you know what? It's possible. I'm not saying it's not possible, but why would they do that? Like, I think the government's main goal is to stay in power, right? They don't want to lose power. And the best way to do that is to keep the ball rolling, to keep people happy, to keep people living their lives. Now, what I do think is going to happen is that their stupid policies are going to end up concentrating all of the wealth and all of the assets into the hands of people like you and I that are out here buying up all the assets. That's what's going to happen. And the middle class is going to get buried. The next generation of kids is going to get buried. And we're going to own all the real estate because they don't understand how their policies actually impact things. So if you notice, they said, oh, we're going to come after affordable housing. And then they announced their fiscal budget for whatever, 2022 or whatever. There's nothing in there to actually tackle the problem. They're keeping rates low. They're not really offering any incentives to anybody to build and develop new supply. And they're reiterating their 400,000 immigrant target. So they're double speaking. They're saying one thing, but their actions show you another. So a little while ago, I stopped playing politics. I used to argue about this stuff. Oh, immigration, there's too many immigrants. I don't care anymore. Bring them all in. I don't care. What I'm going to play instead of politics, I'm playing Monopoly. Like, I'm just going to, whatever Like, you know what I'm saying though? Like whatever
Mm-hmm.
game that the government plays, I'm just going to go take advantage of it. If they change their policies and raise rates, well, you know, asset prices will come down and maybe your cash flow goes up. I'll play that game then, right? So I don't really fear what they're going to do. I'm just ready to adjust, but I wouldn't bet on them like intentionally crashing things by doing something really
Great.
stupid. Yeah.
Yeah, the ability to adjust, though, there's something to be said for that, man. I think like understanding the game of money, how
Yeah.
money works, how investing works, how inflation works, how compound interest works, how, you know, the discipline and the psychology of investing works. When you understand the whole game, you can pivot and you can move your whole strategy based on whatever circumstances we have. If interest rates are 15% again, that, you know, a lot of people say, oh, what, you know, in my day, we had to pay 15% interest rates. Your strategy wouldn't work or whatever, blah, blah, blah. I mean, then go put your money in bonds and get 17% passively.
It's
Like,
a
I
good
don't
point.
have to be in real estate. I don't have to be doing the strategy I'm doing right now. But you can borrow money at 2% or less right now. And inflation numbers just came out at 3.6. You're borrowing money lower than the cost of goods going up. It's free money.
It's so
If you're buying assets that produce income, it is legit free money. But you do have to manage a little bit of this real estate in your portfolio. But you can do it in stocks too.
Yeah, you're right. A lot of like we know this. A lot of people know this. Even as myself as a beginner investor, I knew this. I read the books, but I didn't understand it. Like you see, but you don't see. Like you hear, but you don't hear. Right? And it wasn't until I kind of started getting into the game, like, oh, this is how people do it. Oh, this like it's actually pretty easy. Like everybody's doing it wrong. Like they don't understand. I didn't understand money. I didn't understand compound annual growth rates. I didn't understand the triple header of real estate, of cash flow, principal pay down, and appreciation, and the leverage and the ability to tax-free refinance my money out and go buy more. Like it's actually really easy. It's actually really easy. It's simple. I mean, it's going to take time, but the mindset is pretty easy, and not as many people have the right mindset as we think. And I think the real only way to develop it is like anything else. You got to get in the game, right? Mm-hmm. You go read a book about how to play basketball, step on the court, it's going to be a different ball game, right? Until you get out there and play a little bit, and then all of a sudden you're good, right? You understand it. You flex those muscles a little bit. You work your game, right? Like you got to get in it. So I know a lot of people get stuck on the YouTube videos. They get stuck on talks like this, and then they step into the real world in a competitive market, and they get punched in the mouth, and all of a sudden they're like, "Oh, this is too hard. I'm out."
So where did they go wrong there then? Where did they go wrong? What characteristics make somebody a successful investor, and what makes somebody unsuccessful? Is it the ability or the disability to pull the trigger and take action? Is that where people are stunted?
The first trigger pull.
Yeah,
that's where I lose most potential investors as a real estate agent, is that first trigger pull. They call me up, they've read the books, they this, that, whatever. They think it's going to be easy. They think I'm going to come in and do a BRRRR. I'm going to do this. I'm going to do that. Okay, cool. You want a BRRRR? Here's one. It's going to cost you $80,000 in renovations. It'll work, right? You can get your money out. It's going to take you 6 months projects. You're not in town. You've never done a project before, but this is what you watched on YouTube. So they get punched in the mouth, and it's not as easy as they thought. They have no long-term vision. They thought they were going to get rich quick, and all of a sudden they're gone forever. And that's another thing too. It's the inability to pull the trigger and the inability to project yourself out more than like 1 year or 2 years. And I suffered from this for a long time as an investor, as a beginner. I wanted it really quick. Once you expand your timeline to 10 to 20 years, it becomes so much easier. It's like, oh shoot, I could buy one property a year for 10 years and be a multimillionaire.
And you don't have to worry about losing or paying $10,000 over too much over their offer, right? That $10,000 becomes very minuscule over 20 years.
Yes. Exactly. It's and I don't have to zoom in and see, oh, like there's a little bit of mold in the corner of the bathtub. I'm going to back away from this. But that projection out 10, 20 years, that understanding how real estate works, and even with small appreciation, 3% of $500,000 is $15,000 a year. Like that's the kind of appreciation you should anticipate minimum.
Yeah.
On top of, let's call it $700-800 a month of mortgage pay downs, you're already at 25% annual returns plus cash flow. It's very easy to hit 30, 35% compound annual returns in real estate in a market like Windsor. And those are conservative numbers because right now we're at 20-30% appreciation. So
yeah, it's crazy.
yeah, if you 25% annual returns, like you double your money, I think in 3 years, 3.5 years. Try to do that in the stock market. Try to take $80,000 and double it in 2 or 3 years without taking on like some hefty risk.
So on the topic of taking action and pulling trigger, I think something that people underestimate a lot is opportunity cost. And what that is if you don't pull the trigger, you don't buy this property today, and you wait for that correction, and all of a sudden another year goes by. What did you do with that money? What opportunities did you miss out on during that time, as opposed to just getting into the market? You're going to learn faster, you're going to grow faster, you're going to make some mistakes, which is going to make you better, and you're probably going to get a better return on your money because of compound interest, and you're getting in now.
I love what you said there, because it's not just about like, oh, I made this investment and the opportunity cost is not just financial. It's emotional. It's you actually stepping out of your comfort zone and actually pulling the trigger. That's more valuable than any one property.
Yeah.
And you hit the nail on the head. But those people that are on the sidelines, like I always talk about on Dana and I's podcast, it's fear packaged in, I'm smarter than everybody else. It's fear packaged in, everybody that's buying right now is stupid and the market's going to crash. But
it's all
really,
underlying fear.
You're just afraid and you're making up an excuse. I did it for years. So I know how people think, and I see it all the time. But really, the when the crash does come, I say this all the time. The people that don't have the experience that we have right now, because we've been doing it for 5 years straight. I know what to do when the market crashes because I know my market. Like, I'm going to say, oh wow, this 2-bedroom condo that was $450, I can now get for $325. The rents didn't really drop that much because that's typically what happens when a crash comes. Rents don't drop that much. Like, you might actually be more cash flow positive. I'll look at those properties and be like, oh wow, this is even more of a buy. But the people that were never in the game, they won't really know what they're doing, and they'll probably be even more afraid because in a crisis or in a crash, you turn on CNN, all you're getting bombarded with is fear. So it's going to be even harder for those people because I've learned to not listen to the news anymore because they're always wrong. And they're selling you fear. So I've learned, because I've been in the game, I've learned to not listen to them and just act on my own intuition and not listen to anybody else. But the people on the sidelines, they're not learning that.
Yeah.
And a lot of times they think they're capable of operating in a scary environment, but
it takes experience.
They're not. Yeah, it takes experience. Yeah, exactly.
All right, so I'm going to wait for some people to throw some questions in. There were some earlier. I got to scroll up a bunch to do it. If you guys can repeat them, drop them in here, we'll do it. But in the meantime, the question or the topic will be stocks versus real estate. Why do you like real estate so much better than stocks? I love stocks, I love options, I love crypto, and I love real estate. But real estate's my number one, and I know your percentage in real estate is higher than mine even. So why real estate so much over stocks? Or like maybe 3 reasons.
Number one, Canada is in a housing crisis. There's a shortage of housing in Canada and the U.S., maybe even around the world. I don't know. But so I think the amount of wealth in the world right now that's been created by the internet, a lot of people have a lot of money. A lot of investors are out there with a lot of money. A lot of just regular people have a lot of money. A lot of people are starting businesses, like making millions of dollars on YouTube channels. Like, there's a lot of money in the world right now. And I think the demand globally for real estate is insane. So I want to own as much land and assets as possible. That's number one. Number two, once you understand leverage, you'll probably not really want to buy stocks that much anymore. I still do. I love it as well. But once I understood leverage, the whole mindset changed for me. So anybody listening to this that doesn't understand leverage, do whatever you can to not just know what it means, but understand it. You can own a $500,000 asset for $100,000. You can control $500,000 worth of real estate in Canada, one of the most in-demand markets in the world, for 1/5 of the actual value of the property. You get 5-to-1 leverage on every investment property. So imagine if you had a stock like Amazon that doubled, but you had 5-to-1 leverage. Well, you made 500% on your money. So the 5-to-1 leverage is massive. That's probably the biggest thing that I finally understood. And then number three, the ability to refinance your property, pull your capital out tax-free, have a property that's producing infinite returns, you no longer have any capital in it, then you can take that money and you can scale a portfolio. You can't scale a stock portfolio without doing probably some crazy stuff. I know you do some options and stuff. I don't mind options. You can be pretty safe with options unless you're doing naked stuff and exposing yourself a little bit more. But yeah, so that's the breakdown. I'm sure you're on the same page, but like, what if you had to give a couple yourself? What would you say?
Yeah, man. I think leverage is number one. Leverage is number one. Stability, the stability of real estate versus the stock market. Look at the charts of the stock market. It's up and down. It's crazy. It's an emotional roller coaster. Look at the past 10 years of real estate, 20 years of real estate. It's been pretty steady. It's been easy to take mentally. But on the leverage standpoint, that's huge because people sometimes say, stock market on average or the S&P goes up 10%, real estate goes up 5%. But when you have 5 times leverage, now you're talking 25% versus.
Yeah, that's just appreciation, not principal pay down and cash flow.
Yeah.
People don't understand real estate. They don't understand real estate because of articles like that. My dad even made that comment to me. He doesn't understand real estate. He's like, oh, the stock market goes up more than real estate. Like, no, you don't understand. You have 5-to-1 leverage, cash flow and principal pay down. Like you should be 30 to 50% annual returns in that. So anyways, yeah, I love it.
Okay, I'm gonna hit some questions here.
Oh.
There's one here. How much initial capital and credit should I have to start? It's a common question that I get because I coach people one-on-one that want to get into real estate, buying their very first property. I also do mortgages and help on the lending side, and that's usually the biggest roadblock for people getting started. A lot of it's just mentally. They think they cannot get a mortgage. They think they know the rules and the products, but in reality, they're a lot closer than they think they are. So, I mean, as a ballpark answer, I mean, everyone's in a different situation, but I have clients that are getting started with $30,000 because they're buying a duplex outside of the GTA with 5% down in markets like potentially Windsor, Sarnia, Sudbury, things like that for maybe $250K, and a 5% down payment there is 12.5 plus closing costs, which you get a rebate on, and you still have an emergency fund for things that might come up. And I think that, 15K emergency fund, if this is a turnkey type of property that's not going to take major work, you're pretty safe as long as you have other income sources that are going to only add to that cushion every single month, including the property that you just bought.
Mm-hmm. And if you can, I love the 5% down. A lot of people think, oh, I got to pay CMHC fees, so I'm not going to do it. You got to understand, whoever asked that question, you're controlling a $250,000 asset for $12,000. Like, that's all you need to know. That's like, you're fine. As long as it's a decent location, as long as it's a little bit cash flow positive or better, and as long as you understand whether or not that property needs like a significant amount of CapEx or not. But if you can control those factors, which get yourself a good agent or learn yourself, and you should be able to navigate that, then you should do 5% down and get into the market if that's your only option. But get in like ASAP. I love the advice there too, because a lot of people think that they can't get a mortgage and they actually are closer than they think, like you said.
Absolutely. Someone said options equals leverage. That's true. You can buy more stock or control more shares by using options, but obviously that comes with much higher risk. Hashtag Dogecoin. That person is too advanced for this conversation.
You should be running the show. Yes.
You should be running the show. So you will be hosting it next time if you are a Dogecoin investor. How long before you can refinance your house to pull capital out? That's not a time question. That's when you have enough equity. And a lot of people make the mistake of waiting until their mortgage term is done and, waiting that full 5 years and letting that equity build up. But what's happening is your return on equity in the meantime is going down because you're not accessing it. So the quick answer is, as soon as you have enough equity to make sense financially, you should be refining your money out so that you can put it to work somewhere else. And factor in that penalty. A fixed rate penalty is going to be a lot higher than a variable rate penalty. That's why I always go variable. It gives me more flexibility. But that penalty is a tax deduction on, a rental property. You're going to use the money to invest. And you just have to break the numbers down. This goes back to knowing how the money system works, how investing works, what kind of return you can get, and it becomes a numbers game. So as soon as you kind of have access to a good amount of capital that you can invest, it's time to refi and get the portfolio bigger.
Absolutely agree. And one of the things that I hear people say is, well, if I refinance my property, my cash flow is going to go down. And I always say, what would you rather have? $50,000 now, cash, or an extra $100 a month for, like, how long would $100 a month will take you how long to make $50,000, right?
Oh my God, yeah.
1,200
months.
That's yeah, $1,200 a year, 50 almost
months, 54 years. Oh.
Yeah. Think about that. So I'm taking my 50 grand now, even if that brings me to a break even on my investment property, because here's what I know. If I'm making $1,500 rents right now on my property, over 10 years, the rents are going to go up, right? At minimum, it should be the rate of inflation. So that $1,500 will be $1,800. Well, my cash flow will come back in the future. I'm taking my 50 grand now and I'm buying another asset or something that makes me money. So that's just a common thing I always hear is, but you're losing so much leverage when you don't do that. I actually have clients right now too that are talking about buying properties cash and not financing them. And I say, you know what, that's better than not doing anything. But in my mind, I'm like, you don't understand money.
So there's a quick point I have there. Everybody or most investors are familiar with return on investment and the return they're going to get as soon as they buy a property on an annual basis. But they fail to keep calculating return on equity. As you hold your properties longer and build up equity, that equity is yours. And what is the percentage in earnings compared on all the equity you have tied up in that property? And it keeps going down the longer you hold it, unless you refi. So that's a mistake that a lot of like newer to novice investors make, is they have too much equity in their properties. And if that's the case, if that's you, if you've got properties with a lot of equity, shoot me a message for this, because we can talk about refinancing on the mortgage so you can scale your portfolio for real.
ROE, nobody talks about it. You're right.
ROE is underappreciated. Here's one. I'm a very advanced high finance guy. Can you elaborate to a math guy what you mean by 5-to-1 leverage?
Yeah, 100%. So let's do an easy example here. You buy a property for $100,000 property. 20% on $100,000 is $20,000. I'm going to set my camera up here. So 20% down on a $100,000 property is $20,000. Let's say the market appreciates 5%. Your $100,000 property is now worth $105,000. So you think in your mind, well, I just made a 5% return on my investment. But you got to think, you only put in $20,000, not $100,000. So it's actually 5,000 divided by 20,000, which is 25% return on your money. So I hope that wasn't too quick, but whatever returns the market generates, you multiply them by 5. Yeah. So think of this. Windsor's market appreciated 40% year over year from last year to this year. On all my properties in general, I made 5 times 40%, 200% gains. Now that's abnormal. I'm not like predicting that, but understanding that 5-to-1 leverage is one of the keys to investing.
For sure. And if you're going to be living in the property and it's a single family or a duplex, you can qualify for 5% down, which would be 20-to-1 leverage. If it goes up 5% multiplied by 20, you double your money in a year. That's because the purchase price is 20 times the amount of money that you're putting in. The bank puts in the other 19 times. So that's leverage. And that's one of the big keys why real estate is so effective. We've got a question in the comments section here. Older semi-detached in Brampton for around $750,000, or newer detached in Alliston for $1 million, both multifamily. These aren't your markets, are they?
Yeah, I love the question. I don't know either market well enough to evaluate. I think there's more of a shortage for actually detached single family homes than any other asset class. I would lean towards the detached home if the numbers are similar. If they're skewed towards the townhouse, then you might have something to think about. But single family homes are like, they're going to be, nobody's building them anymore unless they're like super high end, right? So, but good, very good question. Very good question. They're both good. Buy them both.
Buy them both. That's the answer right there. I think I can answer this one. It's, could you run the numbers on one of your Windsor properties? Let's do the one that I just bought through you in 2021, which is a turnkey triplex. By the way, Scott over delivers when he's doing his real estate stuff, and he's a proponent of what I believe in, and that's over delivering if you want to scale a business and be successful. And he was doing video walkthroughs on everything that I was interested in, high quality video walkthroughs. He was interviewing tenants and getting their approval and their true comments and stuff like that too. So it didn't take too long to find something that worked for what I wanted. And this was a joint venture as well I did with some very good friends of mine. And the numbers on it, we bought a triplex that was turnkey, renovated all 3 units for $590, and there were about 633 offers on it, something like that. You know, there's like 18 or 20 something, right? So we won that one, came in at a price that still worked, and 2 units were rented already at top market rent, and there was 1 vacant unit that we had to fill. So we got top rent there too. I think it grosses about just over $4,000 a month for this triplex, renovated at $590K. Running the numbers, the expenses on this property are very low. And I think taxes across the city must be very low, because on this $600K property, the taxes for the year are $2,100. A little over, so like what, $165 a month, something like that. Obviously that goes right to your bottom line. So I was focused on cash flow and mortgage pay down for this property, and the cash on cash return, which is your cash flow divided by your down payment and closing costs. I was looking for double digit cash on cash, and we achieved it with this property. We're in like 11% on a turnkey triplex in Windsor, which is fantastic. Add the mortgage pay down, which is almost another 10%. Maybe it is 10 or 11% equal to the cash flow, and we're over 20% without any market appreciation, in which it already has appreciated since we bought it in January.
Love it. And a lot of people make this mistake when they're evaluating property, especially in multifamily, is, well, I'm not paying $500 for a duplex or a triplex. And I always tell people, don't focus on the purchase price, focus on your return on investment, right? When you're evaluating any property, you're going to look at comparable sales. You're going to look at what other similar duplexes are selling for. But too many people are focused on purchase price. They'd rather buy the $400,000 duplex that makes, like, the percentage return is lower. Like, let's say it's 7%, but that lower number attracts them. But the higher number of properties is actually generating a higher return than most of those lower end ones, because you have 3.
Yeah.
So focus not on purchase price, focus on return on investment, which is just simple math. We just did some simple math there, and it's very clear. So love it. Yeah, we knocked it out of the park on that one. 10% cash on cash return on a turnkey property is like very hard to find, even in Windsor.
Yeah, it's fantastic. I never drove out to Windsor to see any of these properties. I still haven't gone out there to see it in person, to be honest. You know, having your network, a good handyman, repair person, and, you know, just in your network, we don't even have a full-time property manager. It's not necessary, because, I mean, with my experience with these smaller multi-unit 2 to 4, I mean, the problems and the issues are pretty small. You can just call someone to fix it. You don't need to be hiring someone on a monthly basis for those smaller ones, in my opinion.
Really do. They take phone calls. And
yeah, they take phone calls. Yeah.
They do what I do or you do. We just send a repairman.
Once in a while, you can find someone who's really competent and they can do all the repairs for you at a discounted rate. Maybe there's some value there, or if your portfolio is so big or your time constraint and you need to be focusing it elsewhere, then it's totally justifiable. But let's move on to the next one. There's been a couple of comments to save this video. I think it will automatically save to my profile for you to watch in the future. But yeah, that's a good sign. There must be some value here. Does this mean that you can rip out 25% of the value in another mortgage?
It increases 25%? Is that the question?
Rip out 25% of the value in another mortgage. I guess what he's saying is this is a refinance question, pulling out some of the equity and buying another property, another mortgage. If you want to elaborate on that, we can dive into a little bit more. I would love to really get into the game. I'm in so much debt and don't make that high of an income. Any advice? This is more of a personal finance question.
Yeah.
What do you think?
Okay. Clean it up. Like, go to work, man. Go to work. Honestly, Get that cleaned up. Get a job. Work overtime. Save your money. Do the 5% down. House hack. Whatever you got to do to get out of the market, and expand your timeline. It's not going to happen quick. It's going to take 5 or 10 years. It's going to take anybody 5 or 10 years to make any sort of splash.
Hustle mode, right? Hustle mode. When you're in that first phase, you know, being 3 phases, the first phase is where you have a lot of time and you do not have money. The formula is you trade your time for money. You got to increase your skills. You got to, if you work a job, look for ways to get a promotion or add a high value skill. You need to increase your income. If you're making 40, 50K a year, you need to be looking to double that, get into that 6-figure mark at least, and keep your expenses really, really low. Funnel all that income into that high interest debt. If you've got credit card debt, it's tough to get a 20 to 23% return in the markets when you can just get a 20 to 23% return on paying off your credit card debt. So that should be removed first. That's going to increase your credit score, which is going to be huge for you in the future. Credit is massive. As you learn the game of money, you're going to need access to more capital, and that's your credit score. But it's not too important right now, because if you have a lot of debt, then maybe you're not so great at managing money, but you need to be paying down debt. You need to be increasing your income, looking to improve your credit. You can do all those things simultaneously, and you might have to make some sacrifices on the spending side and the fun side and the weekends, and get into grind mode, maybe build a side hustle as well. There's a lot of opportunity out there, especially with technology and social media and all this stuff to build a brand. There's a lot of opportunities. So what are you into? What are you passionate about? What are you good at? What do you have experience with? Build something around that on the side.
Also, go to work. Like, seriously, man. People don't want to work. They don't want to work. I'm not saying him or anybody, but you got to work your way out of it and hustle harder, right? We got to get him one of those.
Yeah, get one of the t-shirts, man. So the elaboration on the former question that we didn't understand was a 5% gain is a 25% to you because of the 5-to-1 leverage. So therefore, do you take out the 25 now that you have that equity? I guess it's going to be a math question again, right? So if you put 20% down and you got that 25% return on investment over the course of 1 year, you've built equity on the upside because the property has appreciated, and you've built equity because you've paid down the mortgage. So there's a bigger spread between what you owe and what the property's worth. That's your equity. So if you can borrow up to 80% of what the property is now worth. So if you just take the current value and multiply by 0.8, that's the type of mortgage you can get right now. Subtract what you owe from it, and that's basically the cash payout you would get on a refinance. And then you have to understand, is it worth it to break the mortgage right now? What's the penalty going to be, and where am I going to put the money? So it comes down to a math and investing question at that point.
Yeah, on a 5% gain, you're probably not going to have enough capital to leverage in 1 year. What we've seen in all across Canada is way higher than that, and 40%. In those situations, you could probably tap that equity really quickly, but usually it takes 2, 3, 4 years to really have enough equity to tap into on a refi. But I like what you said earlier. As soon as you have that equity available, do it.
Pull it out. You got to know where to invest it, though, right? Got to be educated. Here's one, and I'm curious to hear your thoughts on it, because I'm actually not sure which way I swing on this one. Would you recommend putting 5% down on a personal property, or would you recommend 20%?
I got this one. So when I moved back to Windsor, which was a couple of years ago, I bought my personal residence with 5% down. It was a $300K purchase price, so $15,000. I could have put 20% down. It wasn't that I couldn't have. It's that I said to myself, this property is not going to make me money. This property is going to cost me money. I'm going to take that extra 15% that I save, or whatever, 45 grand, and I'm going to go buy something that makes me money. So it depends on what you're going to do with the money that you don't put in, right? If that money is going to rot in your bank, or if you don't know what to do, if you're not good with money, do the 20%.
Or you're going to buy a car or something.
Yeah. Depreciating
Right?
after costs you money, then you should do 20%. If you understand money and you're going to put that to work, you can get a higher return, because my mortgage rate is on that 1.5%. That's my ROI on my personal residence, pretty much. Now it's stuff too, but essentially it's 1.5% money. Mm-hmm. I can make a lot more than 1.5% in any investment property, anywhere in the world, probably. So it depends on I wonder can you tell us what you're going to do with that money?
That's a great point, man. I agree with you there. It's going to be a personal decision of what you're going to do with the money that you save if you put the 5 versus the 20. Now, the downside to the 5 is that obviously you will have to pay that high CMHC fee, and this isn't a rental property that's earning income. So that's kind of down the drain. But I guess the big advantage, and this is what I would do personally, is the 5% down, because I love to maximize leverage on real estate and put the rest of the money to work somewhere else.
You should, and you got to think the CMHC, it goes onto your mortgage, right? It's taxed. And what's your mortgage rate right now? So you're actually you're getting a $10,000 loan at 1.8% or something like that. Pretty cheap money. And really you're putting 10 grand in, but you're saving, depending on the purchase price, you could be saving $50,000 to go invest somewhere else. So I would lean towards the 5% down.
Yeah.
Yeah, unless you.
So what I like. If your plan is to buy multiple properties over the course of several years, then you're only going to get that 5% opportunity if you're moving into the property. So you might as well maximize it when you have it. You can't do that on an investment property. You got to put 20 down. So I guess, yeah, it's just maximize leverage and then go and look for an investment property or
That's
put your
good.
money into some other type of investment.
Yeah, very, very good point. And then he was that 5, 10, 15%. Yeah, I love max leverage.
Yeah, I'm 5 or 20. I don't bother with 10 or 15, but the mortgage rule, like for 5%, if you're buying a duplex, you can do it. If you're talking triplex, fourplex, it's 10%. It's not 5%, even if you're going to be living in it. So max leverage, that's the thing.
I love leverage. I love leverage.
I think we've got maybe one more here. We got another request to save it. We're going to save it. This is more of the complex topic, but I love talking about it. Please elaborate on incorporating. If you owned a private company, would you put the property in there instead of being a personal owner?
So here's the thing. Everybody starts off with this. I started off with this question as well. My answer is this: whatever is going to allow you to start buying real estate now, do that. Right? Usually, that's buying it in your personal name. You get no tax advantages. You get no savings from buying it in a corporation when you're first starting out. Zero. So in general, my rule is, especially for beginners, go buy 5 properties in your personal name because it's pretty easy to do as long as you have a good job and whatever else. Just start. Worry about the corporation after. Also, people come into real estate. I did this myself. I was worried about my 100th property and I had 0 properties, right? I'm planning this massive portfolio. I didn't own anything. So don't worry about your 100th property before you have your first. Don't worry about your second before you have your first. Don't worry about your third before you have your second. One at a time. The corporation generally is going to slow people down.
Yeah, it's a common thing that kind of stalls people, right? You touched on this earlier about like an underlying fear, and then it's like, well, I don't know about the corporate or the personal side, so I get to buy myself a little bit of time, right? But my theory on this whole thing, get your first few properties done personally. The beautiful thing about real estate is it's very, very tax friendly, and you're only going to be taxed on the profit, the net profit, and you have depreciation after all of your expenses. So you can often claim a net zero on an annual basis without the fees of registering a corporation and filing corporate tax returns every year and all that stuff. I think the point at which you incorporate, and I'm incorporated too, I have multiple corporations in a structure, but it was the point where I stepped up my real estate game and got into commercial real estate that no longer even qualified for residential mortgages. Now I'm dealing with commercial mortgages. There's an HST fee. If you do not have a corporation, it's time. It was time. But I had, I don't know, 6 or 7 properties held personally before forming the corporate structure. But another big advantage of the corporate structure is liability protection and not being personally liable if something were to happen. So the way around that is getting an umbrella policy that covers multiple properties. So I always get the maximum liability protection on each policy, which is usually $2 million per property. And then I'd get a $10 million property to cover like 5. That could be used for any of them. So essentially, if something bad happens to one property, there's a $12 million protection policy on that one. And then if it were to get executed, I would get another one immediately. So I always have it in place. And it's rare in Canada, but it's just for peace of mind on the liability perspective. But if you want to scale big into real estate, you're going to have to incorporate at some point. But don't let it hold you up now.
I don't know any major real estate investors that are not incorporated. But I do know a lot that are now incorporated that didn't start out with a corporation. And myself included, yourself included. Again, my recommendation for any beginner out there is don't worry about incorporating until it's time. You'll know when it's time. Go buy your first property 100%.
All right, well, I think we'll wrap up on that point. If you guys enjoyed this, just drop the little likes there to show it, or put a comment there, throw the fires there. Maybe we'll do this again in a couple of weeks or at some other time if people found it valuable. I always like the chats with you anyways, the one-on-ones, but if other people are getting valuable, they're getting value out of this, then we might as well do it here publicly, right?
That's fun for me, man. It's like,
I always like talking about real estate investing and bettering yourself in general outside of money. But if you guys have any questions or something you need clarity on, or you want to invest in Windsor, this is your guy. If you need help with mortgages or financial coaching, getting your financial game to the next level, I may be your guy. I'm happy to have a consultation with you. And I'm sure
Definitely.
Scott's the same.
Mortgage front, you need a mortgage agent that understands your long-term investment goals, because most mortgage agents don't. They don't know that you want to scale a portfolio, so they'll give you really bad advice. They'll lock you in a 5-year fixed mortgage, so you can't tap your equity. Like, just get yourself somebody like Bryan that knows the game 100%. Build your team with guys.
Yeah, there's a big advantage to working with a broker and agent who has experience as an investor, because they can guide you on the I guess the products that different banks have that are going to allow you to scale in the future. It's not a one size fits all thing. And if you go into the bank, you might get a good rate or a comparable rate that a broker can get you, but it's not all about the rate. And I have several clients that are realizing that now, that didn't have the advice or the guidance, that are paying huge penalties to break mortgages to access their equity.
Yeah, you walk into a bank and you talk to some 5-year-old mortgage advisor. They don't know it, like, they just don't know enough to really properly guide you. And a lot of people have the misconception that they can pick any real estate agent, any mortgage broker, any lawyer, any this. They're all the same. No, they're not. They're not.
Yep.
So start building your team with the right people, because we'll help you grow, right? Like, that's the key.
Build a team who's on the same page, that's going to lift you higher and get you to scale in the future.
Sure.
All right, Scotty, it's been a pleasure, man. We'll do this again. Thanks, everybody, for joining.
Absolutely. Thanks, everybody.
Talk soon.
See you, bro.